Today's episode is brought to you by Mazars.
SoundCartel.
It's been a year of shocks and instability caused by a pandemic which has gone on for far longer than most predicted. But 2021 was also a year when house prices, bolstered by continuing record low interest rates, and the share market went gangbusters. Did the federal budget and the Reserve Bank pull the right levers? Or have they set up the economy for even more trouble? From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. We've been talking to Melbourne University Professor of Economics Neville Norman about the economy and how it lays the groundwork for next year. Neville assesses the 2021 federal budget and the actions, or otherwise, of the Reserve Bank, finding that they may have been too inflexible in their forecasts. Neville starts by explaining to Nick Schillberger why it's important to look back over the year that was.
Well, good question is why we do this, Nick, and it's not just tradition, but there's a reason. We should look back at the year we've had, not just to regurgitate history, but to get some tips for the future. So what was it? 2021. Expected to be the end of COVID, it wasn't. Expected to be the end of COVID restrictions, it wasn't, although they're mainly gone, except for the West at the end. We didn't have that many natural disasters, although there was some storm damage, some flood damage, and not the bushfires that we had in early 2020. And thankfully, no business-disturbing election, but you're going to get one in 2022. That's my first prediction. More on that later. But we should look back and remember some important pointers from what happened with massive growth in shares and house prices, not a movement in bargain basement interest rates, and that could create more problems than not. An exchange rate that bobbed around but basically was central. And if I was to summarise the year in statistics, I want to compare calendar 2021, and some of that's even a forecast because we've only got 2 quarters of GDP, with the 10 years, listen carefully for this, of 2010 to 2019, which is the decade just before COVID hit. If we look at economic growth, I think we're going to finish this year with about 3.8% in volume, which looks good, but mostly it's a recovery from the hole we got into in 2020, compared with the 2.4% growth in the teens, 2010 to 2019. Inflation is higher than it was in the teens, rising to close to 3% for 2021, and therein lies a challenge for the Reserve Bank, interest rates and all, compared with just under 2% in the teens. Interest rates themselves, borrowing rates average 6.5% to 7% in the teens. They've been much lower than that at 4 to 5, and of course Reserve Bank rates 2.25% in the teens, and we know throughout the whole of 2021 just 0.1%. House prices, well, cop this one, in the teens, 5.5% average annual growth of house prices in Sydney, 3.8% in Melbourne on the average, 19% in 2021 for Sydney and 15% in Melbourne. Big variations elsewhere, but that is just striking. Shares, 6.5% annual growth in the teens, but 18% growth in 2021, unless the last few days fall apart. And wait for this one. The Melbourne lockdown, a record that Melbourne doesn't really want to claim. No lockdowns for any day in the teens. 113 days in 2021, assuming we don't go back in the month of December, which we haven't seen yet. Now that defines 2021, and that's the year that was.
Now, Neville, you have a very different take to most when looking back at the May 2021 budget.
I do indeed, Nick. I'd say 3 things about it. Number one, it continues to give decimal point forecasts of budget projections, including the deficit, out about 10 years. That's just too stupid for words with all the uncertainties can go. Number 2, it continued the support, thankfully, for businesses. And my economic message is there's no reason why these big deficits will not support government continuing to support businesses. So that's a plus for businesses listening to this. And the third thing is the entire budget was hung on one view only of COVID. And it's in one page, and I'll recite it. From the 20th of May, no further lockdowns and no border closures. That is palpably wrong, but what's most wrong about it is that no other view was countenanced. We'll come back to that later.
And many people would have never picked that interest rates staying so low and house prices rocketing so fast and for so long. What's your take?
Well, Nick, they're connected. The Reserve Bank, for some reason, that's Australia and many others around the world, have decided to keep interest rates low and facilitate the recovery, which they do. But there is a real risk now that this low interest rates have encouraged and caused the house price and the share price scenario, not just because rates are low, because one of the most absurd public policy announcements in history was the promise of the Reserve Bank of Australia that they will stay low for 2.5 more years until 2024.
And what's your latest thoughts on COVID?
Well, my COVID scenarios have always been, Nick, three. Number one, they come off for good, which might happen. They stay moderately, which seems to be the case, and they go back hard for many businesses for much longer. They've been the three scenarios, but the chances or probabilities now change. I'm pleased to say that hard may not happen again, but I don't rule it out. Come back to that proposition. But for much of the country, we're going to have some form of COVID, but not many restrictions into the near future, but keep all three scenarios alive.
And finally, Neville, what about the impact for businesses out of 2021?
Lots of things here. Obviously, the recovery is there and many businesses are coming back. But there's both a demand and a supply restriction. The demand restriction is there's a psychological barrier to people rushing into restaurants, offices, universities and other places, including international travel and even domestic travel, damaged by COVID. That's the demand barrier. The supply barrier is that you're limited in some areas by floor space restrictions, but also labour shortages. And my tip for smaller businesses is it's okay to come back and get your family doing all of this and even not paying them. But if you do your books, pretend that you have paid them because you're fooling yourself if you don't. Now, I have a final tip for all businesses, particularly smaller ones, and that is that rulers are good, particularly if they are better than the crop of government rulers around the world, but ruling out is a bad idea. Putting things to a side is great if you're trying to sort out a box of documents or a messy office and whatever. You've got to focus, but never rule out anything that might be important. And here's my message. Fire drill that many of us did at school and bushfire plans are superb for risk management because they don't rule out extremely unlikely things that might change your life. I've got 3 culprits that are guilty of ruling out. This is called the ruling out fallacy, new concept. I'm trying to stay fresh. 1, any of us who uncritically make or read single-point forecasts like the Australian dollar will be 73 cents on the 30th of June 2022. Don't get me wrong, you need these pointers, but only to start with. Then you have to add the other things that can happen, like the fire drill. Culprit number 2, the Australian federal budget of 2021 in May, already mentioned. Totally erecting all the numbers on one view of COVID, not just, as I said, because it's wrong, because it ruled out every other outcome. And they were wrong. But the top prize goes to the Reserve Bank of Australia that ruled out anything other than the forces that will enable it to keep interest rates right where they are, not just for a month or two ahead, but for many months until 2024. Now, I'm not the only one concerned about this. Terry McCrann, a top journalist, wrote in his columns on the 12th of November in 2021 that our economic and financial future is in the hands of an incestuous combine of the most spineless and incompetent people on the planet. I wonder what he really thinks. And that they don't have the foresight or gumption to raise interest rates. Well, I've got a crocodile analogy. This inflation problem that's looming, particularly in the United States, is like a crocodile in the water. It's been there for a while, it's been inert, it hasn't moved. The Reserve Bank's on the bank, and it's now trying to bury itself to try and find a way out of the promise. I'll cite the Reserve Bank minutes released in later November this year, that in future decisions about the cash rate would be based on the state of the economy and not particular dates in the calendar. They're trying to weasel out from the promise that rates won't go up until 2024. Let's hope that what they do is to see the error of their ways, slowly crawl away, slowly raise interest rates. I don't like interest rate increases, but the alternative, if they leave it much longer, well into 2022, then the crocodile will be merging, the crocodile will be moving towards them, and if they realise that there's a problem and start running, then that means rapid increase in interest rates and real devastation for shares and property. So this is the most delicate matter into the future. Terry McCrann doesn't have any confidence that they're going to have this. Well, I do. I've predicted, and I'm the only one in the Scope survey who did it, that the rates will move in 2022.
That was Neville Norman, Melbourne University Professor of Economics. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.